Hi, everyone. Welcome back to another emergency episode of Trade with Conviction. Today, we have a full house with James, Neil, Michael, and Phil. Hey, guys, how are you?
Yeah, very well,
Hey,
thanks.
good, thanks.
Thanks for
Hello.
joining. I know that you guys are exhausted. We've been creating a lot of content recently and working on weekends, but from what I hear, this is greatly appreciated by customers who, in these time of crisis, are looking for clarity and basically, especially clarity through the noise. So let's start by quickly summarizing what happened over the weekend. I would say that this is not necessarily oil related, but it has a big impact because oil right now, the big story is how long this will last. And the thing that happened was that they elected a new supreme leader, and it's the son of Khamenei, so the previous supreme leader. So what it indicates is that Iran is not backing down, and there's a continuation coming. That's the sort of spirit of that election, which already tells us a little bit about how long this will last, or at least it's telling us that it's not going to be ending anytime soon. And I think this is relevant because it brings us up to the other topic, which is the main one, that the strait remains closed or technically closed, except for Chinese or Iranian ships. So, given the nature of the problem, 20 million barrels per day that are in essence blocked, everything else that we might talk about today is irrelevant. But we have other news, and because it is spreading now into other places in Asia, where every 15 minutes or an hour we're getting a new force majeure declaration from a refiner in Asia, whether it's in China or in India or in Taiwan. So this is something that we've seen the ripple effects of this closure in Hormuz. Inside the Gulf as well, we've been KPC over the weekend announced that they would be shutting in or reducing their exports of both products and crude. ADNOC warned that they might also be reducing exports. So the news is just nonstop, that's for sure. But as Niels was telling me just before, all of this, the main thing that we need to talk about is when is the strait going to open? Not right, Neil? That is the main question mark.
Yeah, that's the one. And I had the impression that at least part of the massive jump in flat price this morning, once markets opened, was related to the long list of, let's say, wellhead production warnings that came out of the AG over the weekend. And of course, that's concerning, but it's all related back to the closure of the strait, right? These are things that might take some time to reverse, but the main problem is that no ships are sailing, right? And of course, that's having a huge knock-on effect on how much crude is available to refine in Asia, and therefore how much products will be available in Asia once the crude has been refined. The problematic basically is the same as it was last week, and the longer the situation lasts, the worse the situation gets on availability of products. That's the main problem.
No, and I mean, obviously, I go back to what we were saying about distinguishing the clarity versus noise, and yes, getting force majeures from one refiner and after another in Asia is important, is relevant. It's basically telling you that the story here beyond crude is actually on products, on distillates, on jet, on fuel oil. But at the end of the day, as you're saying, all of this will be resolved. It will take a little bit of time. You will have some logistical nightmares here and there. But at the end of the day, all of this is due to one single factor, which is the strait. And that is the thing that everyone needs to be keeping an eye on. And I think we will be talking about that later on. But I think, Neil, you were talking about this too big to fail using a financial analogy. But I'm surprised to a certain extent that after a week, all the different political forces haven't really found a solution to this.
Yeah, I mean, there was even a headline an hour or two ago that Macron said he wanted to get some naval escorts
Yeah,
put
indeed.
together. But then also when you look at the fine print, he said, yeah, once the first phase of conflict is over, which I take to mean once there's relatively reduced threat to shipping. I'm not quite sure. It's kind of a hedge from Macron as well on that basis.
Well, I mean, he is European, and let's not forget that we Europeans are very good at making big announcements that are that are meaningless. So let's see. Um, on a separate note, SPRs. So first time we hear about potentially releasing SPRs. Neil, what can you tell us about it?
Yeah, so a lot of people were looking for that last week. Possibly some were surprised it took this long. I think in a similar way to I sort of take one step back and make the comment that it still felt like today that some parts of the market, also the media, hadn't appreciated the size of Hormuz. 20% of liquid supply is absolutely enormous. And in a similar way, it feels like SPR is also overstated, right? Because people go, oh, look, 400 million barrels are going to get released, and China has 1 billion barrels of oil in storage. And that all sounds good. And it's important in the medium term. But in the short term, the problem is how quickly can you draw that oil, right? And that's where a lot of uncertainty comes into it. And so, again, the size of the problem is 20 million barrels per day. It's very unlikely we can draw that much from SPR in the first place. It might be a quarter of that. And then you might get some commercial inventory draw. Maybe you can do a lot on there as well. The point is, it comes nowhere close to solving this problem. And if you're drawing that hard on emergency stocks in the first place, what do you think prices are going to say? Do you think prices really fall in that instance? It's an absolute critical emergency situation, and we can't even more than plug half of the gap. So it's really not a solution. It's just something that temporarily is going to cool prices, basically. But I expect that signal will be faded within a day or two.
Well, I mean, the only solution is the end of the conflict. That's the only solution right now. And with the hope that the conflict does not mean there's a lot of infrastructure damage. That's the only solution right now. But again, what can you do outside of solving the conflict is basically releasing SPRs. But a question for you. So because over the weekend I talked about this oil nationalization where, China, for example, has banned exports, where, Korea has now put a price cap, but most certainly they will not be exporting. I hear more and more this theory that, well, if you had the oil, why would you be exporting it right now, in times of crisis? Where are these SPRs? Is it mostly in the US and in Europe, or do you also have that in Asia?
You have them all over, yeah. So the biggest potential release is very likely to be from the US. They have a large SPR, as everybody knows. There's probably an even bigger one in China, but after having, let's say, scraped through a lot of documents, it seems like the rate of draw that they can have on that is probably lower than the US. And then South Korea can do a bit, Japan can do a bit, and Europe has a fairly sizable product SPR, so particularly gas oil. I would say, generally speaking, the rate of draw of SPR looks like it's going to be bigger in the West than it is in the East. In case that's something that will shape our discussion a little bit over the next few minutes. And there's also a lot of uncertainty about the rate of draw because in the past, SPR has been mandated, right? We're going to release X million barrels over this time frame. And that basically dictates how much oil comes to market each day. So just looking historically at the rate of draws of SPR is not a great proxy for what we can, in theory, do. But it creates a lot of uncertainty because the most the US did in the past, let's say, was something like 1.2 million barrels per day. They say they can do 4, but we haven't seen it. So it's also somewhat untested. So it's all very, very difficult. And just in terms of the nationalization part, there's more and more chat about whether the US is going to do something like that in terms of banning crude exports or product exports, which would be...
And of course, we're going outside of the realms of what we actually know, but I mean, the world is much more of everyone on its own kind of scenario right now. Trump opened up that new political environment, and why would countries not behave that way? You see, oil historically has always been completely interconnected. If you had a problem in one place, you would solve it in another place, etc. But now we might find ourselves in a situation where more and more countries are saying, well, I was net exporter, but in these circumstances, I don't want to release any SPRs. I don't want to export anything. I have no certainty of that, and it's just my gut feeling, but I wouldn't be surprised of that.
DPP freight as well, just if I can butt in real quick, because on Thursday and Friday last week, for example, if you were to look at the April FFAs for TD20, your US Gulf Coast Aframaxes, TD25, and your TD20 out of WAF for your Suezmaxes, they dropped over 2 trading days by almost 40%. And I think this distinction that Neil's making about where the SPRs might be released from is quite important, because there's been a lot of headlines about how large China's SPR is. So at a high level, I think freight traders are looking at that and going, okay, well, if China's going to release all the oil, well, then there's not as much need for freight. So these vessels that are ballasting into the Atlantic, if China doesn't need oil, well, what are the ships going to do? So there's this ripple effect of these SPR headlines and what that actually means for the freight forward curve. Your spot prices are still strong, but your April and May sold off pretty hard.
And just if I may, to go quickly back onto that kind of story about oil nationalism, every energy ministry in the world, even when the oil market was as interconnected or geopolitics as interconnected as ever, every country will have a resilience plan for energy and for oil, which does not include relying on any other countries, right? This is when crisis hits, you shut down and you focus on implementing your plan for your country.
Absolutely.
So it's not surprising that we see this.
Absolutely. But coming back to the location of the SPRs, even if the SPR was released in the US, you still have the length of travel into where the problem lies, which is currently in Asia or Asian refineries. So, I mean, is this whole time horizon solving the problem? And when you solve the problem and when you see the impact, and how do you trade this? Because there's the crude trade that perhaps there's a momentaneous relief. And as you said, it's like a drop in the ocean, but it's still a small relief. But the impact on products will only be 1 month later until the product arrives. By then, maybe the strait is open again. And you see, so it is very chaotic. And it just tells you the story of crude, but it doesn't tell you the story of products.
Yeah, and can I make one more point in that? Just because, sorry, Phil, I saw you were going to say something, but unlucky. Just at one point, we're starting to do sort of back of the envelope calculations like, okay, normally you say in a situation like this, Europe is the global short of distillate. But if you reduce Asian runs by 10 million barrels per day, let's just say that, then for sure, Asia is the new net short on distillate. We're trying to think about what can Europe do to solve itself. And SPR, gas oil SPR at least, not jet, is one of the ways to solve that. A bit more runs, they have all the crude they can access. It's short haul. US is going to release some SPR crude. Great. Like the West can run, and maybe they can cover the shortfall from SPR for a month or two, or maybe 3. And then we have to solve Asia still. So even then, you still have this huge onus to get crude and products from the West to the East.
Yeah, absolutely.
Yeah, I think if I go on to talk about kind of products pricing in general, I think that you've just summed it up very nicely, right? Let's say we have a contingency where Europe can continue to operate somehow semi-normally for a couple of months. That's not the case in the East, right? It's the timeline is a lot shorter, especially for products like jet or for naphtha. And so if we look at kind of where East-West is pricing, on gasoline, on jet, those were positive, but then on jet, at least it's swinging wildly. And it's very difficult actually at the moment to determine what these prices really mean, right? It seems clear that Asia has the biggest problem, probably. We'll maybe debate that in a bit. But ultimately, we have to move, as you say, we have to move products from the West to the East, and somehow pricing needs to support that. And that issue in the East, we have to go back to that oil nationalism, right? It's China, South Korea, Japan. If we think about those 3 alone, and we add that to the about 20% of global waterborne jet that comes out of the AG, China, South Korea, and Japan would contribute another 20%. So we're now talking about somewhere close to half of all global jet exports that might be under pressure. And then you have to look at where are the biggest net importers. And then you're looking at places like, we were talking about this earlier, talking about Australia, talking about Singapore, other places in Southeast Asia where you're really only days or weeks away from proper supply shortages. Just to round up quickly on prices, there's also naphtha that we should probably talk about a little bit. Naphtha cracks are negative at the moment still. And the question is why, right? It seems as though spreads have been doing what they can to keep prompt cracks relatively high or relatively higher, but they've been just struggling to keep up with the pace of flat price at the moment. The East-West is calling for max arb, obviously from Europe into the East. But on naphtha, I think we again talk about it in a bit more detail, but demand destruction can and does occur very quickly and has seemingly occurred first, with the bigger problem to solve in that space ultimately being gasoline, where demand destruction is more difficult to implement.
So is that the reason why you think is the demand destruction? Petchem getting to naphtha getting to a certain flat price level where petchem demand disappears. Is that? I mean, I've always heard that from my naphtha guys, but I've always struggled to believe that you can basically switch off demand like that on petchems.
Well, we've seen the majority of those force majeures that we've been seeing out of the East have come from steam crackers primarily, right? You get refineries kind of following suit, but the majority of them have been from steam crackers. And it does just take time for the kind of petchem product prices further down the value chain to catch up with big movements on oil flat price. And it's ultimately then up to the rest of the economy further down that value chain to determine whether or not this new price is worth paying. And so that we need to see the price response from the end user or the kind of the chems further down the value chain before we can really see naphtha pricing up again to incentivize, or on the back of those steam crackers wanting to come back into the market.
Fair enough. Michael, should we move on to freight? You were talking about West African prices going down. Tell us what's the story there.
Yeah, there was just pretty aggressive sell-off in the forward curve of, in particular, TD25 and TD20. And I think a little bit of that is a reaction and perhaps an overreaction to the news about the SPRs. Because again, the headline is China has all of these days of reserves that they can release. And if they were to do that, not taking flow count into account, but that would mean there's just less demand for your DPP loaders out of the US Gulf Coast and out of WAF. Now, I think people are also looking at ballaster counts and seeing them starting to lengthen and indicating the Atlantic. So that's the kind of double-edged sword there of lengthening tonnage, bearish, and the potential for fewer cargoes. So that's what played into April and May pricing, in my opinion.
That's a big if China does release the SPRs.
Yeah.
And
it's
what about
just the headlines they were reacting to.
Yeah, fair enough. And what about the VLCCs, Suezmaxes in the Middle East?
Yep. So I've been watching fixtures and ballasters over the last couple of days, and I've seen several fixtures out of Yanbu indicating east, half of them indicating India. So I saw 4 fully fixed Vs loading in roughly 2 to 3 weeks from now, and 2 fully fixed Suezmaxes loading in about 2 weeks as well, all from Yanbu. So we are starting to see that now, fixtures happening and flowing to the east.
Wow, that's interesting. Wow. Okay.
Anything else on the freight market?
Yep. So I also wanted to briefly mention West Coast India because of Trump's announcement last week about the temporary desanctioning of floating Russian crude. And that's bullish TC12, which is your West Coast India MR loaders. And when I look at the fixtures over the last few days, I've seen uptick in your MRs fixing diesel from West Coast India, both into Singapore and into East Africa. So I think for your East of Suez CPP FFA markets, TC12 is the one to bet on. It should move higher. And then overall, US Gulf Coast for CPP remains the standout CPP load region. So if I was a CPP owner, I would be ballasting west, and rates are high, earnings are high, and also our internal freight model at Sparta is indicating rates to jump another 30 world scale points or so to 433 world scale. And earlier today, I had a look at ballaster counts. And for example, the AG, and this makes sense, but the AG month over month, there are 37% fewer ships pointing to the AG ballasting. Then for West Coast India now, there are 66% more ballasters indicating West Coast India, followed by 35% more into Northwest Europe, and then followed by just 13% more into the US Gulf Coast. And the point I'm making is the US Gulf Coast has a lot of cargoes that they can push to water. Tonnage supply is already tight, and it also has the fewest number of ballasters indicating the US Gulf Coast region right now compared to the other main load regions for CPP.
430, huh? I mean, you say that so lightly, but it's insane. 430.
Yeah.
And it's, or where is it now? 400, but it can go to 430? Is that what you're saying?
Yeah.
Jesus.
And And earnings will be over 200K a day. And for a lot of long haul voyages, there have now been 3 fixtures into Australia for over $6 million lump sum.
Amazing.
From the US Gulf.
Yeah, from the US Gulf.
I think
Wow.
the term off the charts has never been more applicable, right?
Yeah. I had a bunch of friends asking me this weekend if there was any ETF to buy tanker stocks or anything like that. We need to figure that out very quickly. Jesus. Neil, should we move on to crude?
Yeah, I can do quickly. Yeah, of course. Apart from, I mean, we don't really want to talk a flat price very much, but obviously we're in a situation where we've got Brent spreads $7 per barrel, pretty decent. And one of the things we're noticing is that, and it goes into what Michael's just been talking about. You would expect that the whole of the physical market on crude is very, very strong. And while that is true in some locations, it's particularly true in LATAM and the sort of US Gulf Coast sours. It's not true everywhere. So we had quite a lot of conversations about the lack of reaction in WAF so far, also in the North Sea light sweets so far. Those differentials have basically done nothing over the last week. We're trying to figure out why that might be. And it's also reflective, I think, a little bit in DFL. So if you look at the April DFL, we've got $5.85, but the May DFL is $6.85. That goes against the structure in the paper as well. So maybe that's what we're talking about. Maybe there's just too many refiners in Asia who are either in wait and see mode, or they simply cannot really risk taking a long haul cargo at these freight levels. So the natural reaction to that would be, oh, well, don't they hedge? Don't they hedge the margin? And, it might be that too many institutions in Asia don't hedge, are too bureaucratic. They don't have a lot of practice in this area. And now they just don't clean out WAF and Brent in the same way that you would think. Plus, you have the Indians are going back to Russian. Plus, you have refiners asking for SPR. So the physical market in certain areas is really hot, but actually has done nothing in other areas. So it's just I think that speaks to how difficult the situation is for refiners in Asia in general at the moment. The other thing which is extremely volatile is TI Brent. And I think that is also related to what Michael's been talking about in terms of the big sell-off in TD25 on Friday. So that's one issue. Plus, you're probably going to have big reactions to SPR headlines because, of course, if you inject a whole bunch of crude into the US Gulf Coast, that makes a difference on your TI Brent, where the fair value on TI Brent should be. And the other factor is if you have geopolitical premiums rising $10, $15 in 1 hour, basically, that also gets reflected rather on Brent than on TI. So it's super volatile. It's very, very hard to trade. I've been going back and forward with people this morning. What's your view? Most people don't have any real conviction about what should happen here. And yeah, another big question is simply Yanbu, right? So we've already spoken about that. That's one of the escape valves that might be that will be very likely be of high interest to Asian refiners and possibly less so to the Europeans. And that might be another reason why Brent isn't ripping. It was doing about 750 kbd of exports prior to the crisis. Apparently now we are doing something like 2.5 million barrels per day. And where there might be room for a bit more, that does move the needle a little, but it still would be something like less than half of what Saudi has been exporting through Hormuz prior to the crisis. So it can only do so much in the next days.
So if I understand correctly, then, in a sort of market, in an efficient kind of market, when you cannot get a supply from one area, then you look for the next area. But right now what you're saying is that to a certain extent, a lot of these refineries are not buying another type of source of crude, and they will end up closing. Is that what you're essentially saying?
I mean, it might be that we just need to wait a bit more. I mean, so one conversation I had on sort of Thursday, Friday last week was that the flat price is telling you something about what the market expects, right? The market expects this to be short-lived.
Yeah.
Margins in Asia were saying, hey, we're in a bad place already. There's something very urgent going on. So that might have been something that entered into a refiner's sort of psychology in Asia as well. Basically, I don't risk procuring a cargo of crude this week and I kind of push it to next week. But then once it becomes clear this problem isn't going away, then maybe the Brent market starts to move a bit faster this week. But yeah, I think what you're saying is that it's not very efficient right now. So maybe it shakes out in the next week.
Interesting. Okay, so we're still in, for lack of a better expression, deer in headlights mode, where we're waiting to see what happens and before making any kind of drastic decision. Interesting. Okay.
Good.
James, should we move on to distillates?
Yes, please. Yeah, let's do it. I was actually interested in something that Neil and Michael were speaking about. Yanbu increased crude exports. And Michael, at the moment, you're seeing most of that fixtures heading east, not west.
Yep. Every single one of them fixed over the last 7 days is indicating east. A couple of them indicating West Coast India. But yeah, still all east.
Okay. All right. So on distillates, thanks very much, Michael. And on distillates, we've seen like a real uptick in the HOGO over the last few days. So up, I think, by something like close to 12 cents per gallon. And that's likely because the US or the pricing is trying to shield supply into PAD 1 and 2, the New York greater region, essentially. Now, this has done enough to close US Gulf diesel MR ARBs into Europe by over $50 per ton. Really absurd numbers. So actually, interestingly, because of the strength in European jet pricing, US Gulf MR jet ARBs to Europe do work still and work very substantially. Now, we've seen West Coast India LR2 diesel and jet cargoes clearly pointing east at the moment. And Indian exporters are noting that if the margin differences between east and west are marginal, they're more likely to send these cargoes east because of the sanctions, documentation, origin scrutiny, essentially, in Europe. And we've even got Red Sea LR2 diesel ARBs shut into Europe now as well. And we've also heard of cargoes U-turning and heading to Asia from West Coast India, essentially. And again, that's probably partially due to that compliance issues around documentation. But also, there's issues of shortages in East Asia itself as well. Now, something that in the team we've been discussing quite a lot, and we've kind of alluded to a little bit in this call, is that we've had real volatility in jet and gas oil east-west since the start of the conflict, essentially, but particularly over the last few days. And we've had periods where both have been positive, but there's just been wild swings in both, particularly in the front, that probably indicate limited liquidity. Probably the Swiss in the same issue in Singapore regrade as well. Now, it's something that we've been debating in the team about which has the worst position now. They're both very bad between Europe and Asia at the moment. And I found it very convincing, some of the arguments that Phil and Neil have said earlier in the call. I guess structurally, normally, Europe is the bigger short, or bigger percentage short of its demand than East Asia. And I guess their argument, if I was to paraphrase for it, is that the size of the short in East Asia has been massively increased by reduced runs, essentially. But I see now from Michael that we've got Yanbu cargoes bringing crude into West Coast India. We've got all West Coast India, or most West Coast India distillate cargoes heading into East Asia as well. I guess I think there's still an argument that we've got a serious problem brewing in Europe as well, perhaps bigger than East Asia. What do you think?
Sorry to jump in, but I think this goes back to that little table that you had, Neil, where I don't know if you can summarize the going back to the Strait and the impact of the Strait, okay? Because the important thing to remember is that 80% of that crude was going or normally goes to Asia. Let's just remind, the numbers here. Neil, maybe you can summarize that table that you had.
My little back of the envelope table, you mean?
Yeah.
The very accurate one. Yes. Well, we had something like pre-crisis Hormuz flows of crude and products being about 20 million. You take off 2 million barrels a day because Iran is still flowing unless the US invades Karg. Then maybe you have SPR draw globally that can solve another 5. You have Yanbu, which can do incrementally 2. And then maybe you can have oil and water draws and other floating inventory draws of maybe 1. And that means we've solved half of this problem. So we're left with 10 million barrels per day of problems, which get solved through lack of runs, which gets solved through demand destruction at the consumer level, which gets solved through government interaction or government measures, let's say. Now, this is all very, 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 very rough, right? I don't know what the SPR draw is going to be, all that kind of stuff. But it is a massive problem, and it's mostly going to be centered in Asia as things stand.
Well, that's what I wanted
Not
to
all
get
the demand destruction, of course, but yeah.
That's what I
Yeah.
wanted to get to. So, look, this is a back of the envelope calculation, but none of these figures on its own are shocking. 5 million of SPR, it's already on the high side. Yanbu 2 million, that's sort of a given. Oil on water, and you end up with 10 million barrels less. And most of it, let's say, is crude, and 80% of that normally goes to Asia. So, in theory, Asia finds itself in a situation where it has 8 million barrels less of crude to run. So if you extrapolate and you take this to the extreme, you have 8 million runs less of crude, so, or it needs to be substituted with crude coming from Brent or the US, and some of it is already included into the SPR calculation. So, for me, when you ask the question on Asia versus Europe, if you're looking at this on the angle of the normal times where Europe is always short, but you're now looking to a scenario where Asia is now shorter because it's not producing as much, or it should not be producing as much, then the argument is much more of a time sequence thing where Asia needs desperately that oil first. And as a consequence, then Europe will need
Sure.
even more of the oil, but at a second stage, or they end
Yeah,
up
very
fighting
good.
for the oil. But it's a different story in gasoline. We'll talk about that, but it's a very similar dynamic. But that's why I wanted to bring up the numbers here, because it's not the same scenario as per usual.
Yeah.
Oh, yes, extraordinary.
Sure. And it goes back to, I think, what we said at the very top of the podcast, right? Maybe a lot of the focus has been on crude, but realistically, it's products now as well, because it is impacting runs. Yeah, sure. A relatively quick wrap up then. We mentioned briefly that gasoline east-west is also positive now. Spreads are obviously rallying on the back of the fact that we have expectations of supply shortfalls, right? The question then is, how high is high enough on these prices? At the moment, the east-west looks like it's done enough. All of the ARBs that we're tracking would be suggesting that either, depending on the window, but at least for the next weeks or months, almost every destination in both Africa and the AG, much of Southeast Asia already, West Coast Americas, everything is pointing to either the US Gulf or to ARA for its resupply.
Yeah.
That is telling you that is kind of the solver in the short term, at least. We need to move as many gasoline molecules from the west of Suez into the east as quickly as possible. And that's something that we're seeing already, or we should start to be seeing now in freight as well, with those freight rates that are relatively high already, but the paper pricing has done enough to overcome them. And maybe there's even some further upside, as we can see out of the Gulf Coast in particular for freight, and that can be absorbed. If we look into what the physical market is
I
doing,
have a slightly different picture, in terms of
Sure.
slightly different view. I think it's important to look at the cash dips in this kind of scenario. And when we look at the cash dips in Asia, and again, when you're looking at 92, you need to be looking at Far East, not so much East Africa or Middle East or Red Sea kind of imports, because obviously that will help, but on a supply and demand basis, but on a pricing basis, you need to be looking at Singapore. And in Singapore, what we've seen is that the cash dips normally tend to cool off when you have like massive spikes on spreads or cracks. But in this case, they've actually continued rallying these cash dips. And to a certain extent, you have a lot of refineries that are refusing to offer cargo. So sometimes these cash dips that have been quoted are theoretical. They're not even true, because there's no molecule attached to it. So my point being is that on the East-West, has it done the job? Or, if I'm positioning myself as, should I be long east-west or should I be trimming my long and maybe going short? Well, the cash tip is telling me that this is still a pool kind of environment, and there's potentially room for that east-west to continue going up, despite the fact that it's already at the highest level we've ever seen.
Sure, you're right. I think when I said obviously east-west has done the job, right now it looks as though the ARBs would be workable. That doesn't mean that we can now kind of roll back on that paper position or start trimming it, because freight is going to probably keep on rising and taking up part of that as well. And as you said, just the situation that you have in Singapore remains extremely tight. I'd be interested to look into how much those cash diffs in Singapore have been rising simply because freight has been rising, and these are all kind of delivered diffs into Singapore, or how much of that has been actual FOB, differences or changes in the FOB price. that has been quoted for these barrels. I would imagine to a certain extent that it's very difficult to actually get FOB quotes out of a lot of these refineries at the moment because there's simply not going to be that supply around. That goes in the same direction that Singapore is only going to continue to get tighter and that your East-West can continue to rise with it. But I think just to wrap up, I mean, as we can see, if we're looking at, just to go back to, yes, we're pulling a lot of barrels out of, or we should be starting to pull a lot of barrels out of Europe, out of the US, and these are barrels which should have been around still in April or May to kind of kick off a higher demand period in Europe. And chances are, unless something really dramatically happens in the next few days, these barrels are going to start to be pulled east, and they're going to be missing also now from Europe come the summer. So we were having a look at kind of deferred cracks as well last week and still this week. I think there's a story there to be looked at in terms of potential upside still on deferred cracks. But if we look at kind of a US versus ARA scenario over the next couple of weeks, it's very mixed in terms of where are we going to pull hardest. And I think ultimately the answer is it doesn't really matter right now whether or not ARA is a couple of cents per gallon cheaper into some LATAM destination or whether it's the Gulf Coast. The market is, or the marginal market is to pull these barrels east. Yeah. The market needs to, including freight, continue to price to allow that over the next few weeks at least.
Fair enough. What can you tell us about gas naphtha? I was looking at that. I was quite surprised to see gas naphtha actually rally, given the fact that at the end of the day, there is a real story on naphtha and on gasoline where, cash dips were coming off last week, which again, as I said before, is logical when you have these spikes on spreads. But
in Europe,
we would expect, as you said, that the ARBs, we're in a chaotic environment. There's, one thing is the theoretical ARB being open, the other one is the reality. Finding someone that, wants to buy at these prices, finding a ship owner that is willing to go that route, it's not obvious right now. But what the tool is telling us is that the ARBs are now open and that Europe should be supplying a lot of at least East Africa, Middle East, etc. When I say Middle East, I mean mostly Red Sea, not so much, not the Strait, of course. But
even Pakistan is open from Europe right now.
So. Pakistan, etc. No, that would make sense. But that is a theoretical maybe that it should happen, and it's more a question of when it happens than anything else. But naphtha is a reality. What do you think about that?
Yeah, I think so just to go back, gas naphtha has been rallying, and the question is, why is naphtha not stronger when, if we're losing crude runs theoretically in the east, and the east is very short on naphtha, why does the naphtha market not react more strongly to try and incentivize more of those naphtha molecules to stay into that pool? And the answer, I think, has to go back to demand destruction. Right? We mentioned it at the top of the pod. I think it is just faster and easier to cut demand out of the naphtha market than it is straight away, at least out of the gasoline market. So yeah, those steam crackers are sensitive to their margins, and it will take time simply for the petchems down the value chain to price up and to try and bring those steam crackers back into the market. I think for now it seems that the market is just focused on the larger volumetric problem, which is still gasoline. If we look at naphtha ARBs out of the Med, for example, in the very, very prompt, maybe they are workable into the east, but there isn't really an active cash market in the east to try and target at the moment. It's a chaotic environment, as you said, in terms of not knowing really what steam crackers are going to be functioning and willing importers by the time you get there. So I think it's not as clear on naphtha as it is on gasoline that you will even have end user demand when you get it there, which is probably also impacting then European prices and willingness to move.
Interesting. I agree with your point on the deferred cracks, by the way. It makes sense. Sorry, Neil.
Yeah, it's a kind of gasoline is more of a kind of second order, impact, I guess, in all of this, but it's the one with the longest tail potentially.
Yeah, I agree. Any last words, Neil?
No, I just wanted to say it mirrors a bit what looks like is going on in the WAF crude market, right? It's like you've got such a big change in demand to the downside from Asia that it's not allowing let's say the Brent like crude market to price up yet. And that looks like it's sort of the same thing as what might be happening on naphtha. There just isn't a market yet. And maybe a few weeks down the line, you start to see it happening. I've got two more headlines that happened whilst we were sitting here. One is that Iran has threatened closure of the Red Sea. And the other one is that, as if we needed that reminder, like that was basically always in the cards, right? But the other one was that I think the G7 are not going to release SPR at this point in time. So we'll see.
Yes.
Politically, it's not getting handled that well.
Amazing stuff. Yeah.
Okay.
Come back when price hits 150.
Anyway, guys, so thanks a lot for your time today. Let's catch up later on the week. Let's see what the market is telling us. And yeah, thank you very much. Take care.
Thank you. Bye.
Thank you.
Bye. Bye.